Hello and welcome to the latest Insider interview. Our guest today is Alec Cutler, manager of the Orbis Global Balanced Fund. Alec, thank you very much for coming into our studio.
Thanks for having me.
The fund has performed very well this year. It's thriving in a world where US shares are falling and the dollar is falling, but undervalued shares are doing better. So why is this, and what types of companies are performing well for you?
Well, I think you just described it. The important thing to keep in mind is what's working today are investments that we made 2, 3, 4, 5, 6 years ago, some of which were quite painful for the first few years. So we've had some comments about, performance looks too strong now, but it's coming from investments that we made not just in terms of buying the stocks or bonds, but periods of tough performance as we built those positions when people didn't want them, and shares can stay out of favor for quite a while. But some of the themes that have worked well thus far this year: defense continues to work well, critical energy infrastructure, as the world recognizes that the bottom of the pyramid of needs is quite important. So the bottom of the pyramid being things like national security, energy security, food security. Right above that, industrial security. So do you have a decent industrial base? Because all the things that are above that, things like social programs, don't exist unless you have a firm base to your nation and your economy. So all of that, the refocus on the base of the pyramid has been where we've been investing and preparing for years.
You're a bottom-up as well as a top-down stock picker. On the top-down, on the macro, what type of world are we living in today, and how do you invest in this world?
So there are new areas that are emerging that were quite popular 4 or 5 years ago, and things like biotech we're starting to look at. But more so, those themes of energy security and national security are the fringes of those themes are beginning to emerge. So nuclear. Is that a national security issue, or is it an energy security issue? They're kind of somewhere in between. So nuclear is becoming quite interesting, and that's not just buying uranium, but that's really understanding the building blocks of nuclear, the importance of nuclear, the resilience of nuclear. Is this just a fad, or is this, as we think it is, going to be the primary energy input 5, 10, 15, 20, 25 years ago? It takes 10 years to build a nuclear power plant, so it's not 5 years. But 10 years from now, we'll start to see significant nuclear power plants, many small modular reactors come online, and that will be regrow as the base of the electricity infrastructure of the world.
People often talk about growth versus value. You're very much a value investor, and value has been the best place to be this year. So are we at a juncture where in the future value shares do better and growth shares will struggle?
So first of all, just thinking about it from real big picture and putting today in a historical context, the world had become fairly complacent after Vietnam, after the fall of the Berlin Wall, that this thing that was called a peace dividend was forever. That the world was going to be a peaceful place, we'd all get along. Globalism was a very popular thing. And then we've started thinking about maybe we're re-entering a Cold War. I think that, and we've been believers in that. That's part where the defense weighting came from. I'm beginning to think that we've been wrong in that regard. And then instead of re-entering a Cold War period, we may be reverting back to the way the world was from caveman times to World War I, which was every country for themselves. No grand alliances, but temporary regional alliances or temporary alliances that were more indicative of, a quote from Henry Kissinger, who said, America doesn't have any permanent allies or enemies, only self-interest. I think we're reverting to a period like that. And that quote never made sense to me until very recently, if you look at the way that not just Donald Trump is behaving, and but the way the rest of the world is behaving. Countries are acting in their own interests. They're focused on that bottom of the pyramid of needs. How do we create national security? How do we create energy security? How do we create food security? How do we make our industry competitive? Less about alliances. And if you look at the grand alliances that were created after World War II, many of them were breaking down. The World Health Organization, the WTO, the UN. Things are these grand alliances are falling apart.
And in this world, what do you buy and what do you avoid? What's the key investment decision you need to make in this new world?
The key investment decision for us, we believe, don't buy expensive things and look for things that are selling well below their value. So just block and tackle, do the hard work to find things that are undervalued, where we believe there's a catalyst that can return them to normal value. And while we're doing that, avoid things that have very high expectations in them, where you don't know, as you just described, you don't know how the world's going to play out. Good things could happen, bad things can happen. But invest in things that don't have the expectations for things to continue to be good.
What could cause the fund to keep performing well? And importantly, what could cause it to underperform?
The biggest risk in the world that we see is inflation. That's driven by government's overspending. So that's the risk that we're kind of prepared for in the portfolio. So the risk to the portfolio from a relative performance standpoint, not really an absolute performance standpoint, but a relative performance would be a reversion to the environment that we had for much of the last 15 years since the global financial crisis, of governments smashing liquidity into the system, of low interest rates that are kind of manufactured by central banks, and that drive the discount rate down, or the valuation rate of future cash flows, and make the mega cap growth stocks look very attractive again.
Your UK allocation is quite high versus peers and versus your benchmark. So why do you like the UK market, and where are you finding the best opportunities?
We like a lot of companies in the UK. We find the UK market to be very attractive. You think about it from us as contrarians, what do we want? We want excellent companies that are valued like crappy companies. And we find a lot of those. The problem is, as you point out, that's been the case for a long time. Having said that, I think the UK has outperformed the US over the last 12 to 18 months. So you're starting to see some momentum build behind the UK, and we've had very high success in our UK holdings. They're up a lot. But we bought them so cheap, so inexpensively, that they're still very inexpensive. Names would be like a Balfour Beatty, one of the best engineering construction companies in the world. We were able to buy over a 7-8 year period where the cash on the balance sheet net of debt, plus their portfolio of infrastructure holdings, where they own toll roads and student housing and government military housing, where they're kind of getting rent every month, very secure, low-risk assets. The value of those assets plus cash, more than the market value of the company. So we're getting one of the world's leading engineering construction firms for free. Recently, the shares have performed nicely. We're starting to see it pay off for that investment, but it's still very, very inexpensive. Keller is the world's leader in geoengineering. So they're the ones, if you want to build a harbor or a road or an airport or a building, a school, fire station, you have to put a foundation in first. These are the guys who you hire first, before you do anything else, to go in and test the ground and decide what kind of foundation you need, and then put the foundation in, whether it be pilings are needed here or just straight cement here. They're the ones that do that. They're the world's leader in it. The cool thing is that oftentimes in developments, the developments go out of business and a contractor doesn't get paid. They're first. You don't do anything until you put a foundation in. So Keller gets paid first. They're the leaders in what they do. And we're able to buy Keller over a 3-year period at 4-5 times earnings. The stock has doubled and they've grown earnings, so we own it at 8 times earnings. It's a fantastic company. If it was listed in the US, it would be 20 times.
Do you think more international investors are waking up to the UK market being attractive and actually are finally, slowly taking the decision to allocate less money to the US and more to the UK and Europe? And does that excite you or worry you a little bit?
I think we're starting to see that because you just look at the performance. So momentum is starting to build in Europe and the UK, and the momentum is starting to wane in the US. Historically, over the last 5-6 years, tons and tons of money flew out of the UK and Europe and the rest of the world into the US. So there's this massive wall of water, money that's been plowed into the US and pulled out of everywhere else. That's starting to come back. As that gains momentum, we'll benefit tremendously from our holdings in the UK and Europe and elsewhere.
Emerging markets is another overweight sector. So where are you finding the best opportunities there?
There are tremendous companies in the EM. The perception that people have is that they're lesser companies or input companies. Taiwan Semiconductor, I think the most important company in the world, is in the emerging markets. It's very attractively valued in part because it's in the emerging markets and has some emerging markets type risk, like China invading Taiwan. But to be able to buy the most important company in the world at 17 times earnings, we'll do that all day. And we can, balanced and cautious, have the ability to hedge out some of the fat tail risk, if you will. So we can short the Taiwan dollar, we can short the Chinese renminbi to hedge out some of that Taiwan Semiconductor invasion risk and get that 17 multiple very attractive emerging market company for a very attractive price.
Orbis funds have a quite unique fee structure. The actual management fee is zero, but there is a performance fee. So can you explain how that works?
We charge zero base and 40% of the outperformance of the benchmark. So if we don't outperform the benchmark, if we perform in line with the benchmark, you're getting basically an index fund for free. No charge. If we outperform, we take 40% of that outperformance, goes into reserve, and starts filling up a reserve. That reserve, if that reserve continues to have funds in it, we pull our fee from that reserve at 30% of that reserve tank a year. If the fund subsequently underperforms, the money flows back out of that reserve into the fund. So a very, very unique fee structure that we think is very, very fair, has us incredibly aligned with our clients, which is why we like it. And it's the only fee in the reserve, only fee in the world that can produce a negative fee.
And over the past few years, do you have a figure of what percentage of the assets as a fee you've taken out of the fund, and how has that affected net returns for investors? Have they still been very strong?
So the net returns are purely a function of the gross outperformance, the gross fund, and then 40% of that outperformance going into that tank. And I think the last 5 years we may have underperformed in 1 or 2 of those years, and some of that money in that reserve tank would have gone back into the fund via a negative fee. Our fee, our net fee from that, from the inception, from 2014, has I think been around less than 40 basis points. So I think we're one of the top performing funds in the UK doing what we do, and we've charged 38 basis points.
And finally, the question we ask all of our guests: do you personally invest in your funds?
As an American, I have difficulty doing that. I can't invest in the OICs. I can't even invest in our Bermuda funds. But I'm as invested as I can be.
Alec, thanks very much for coming into our studio.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.